the intrinsic value. That's really the primary reason why the intrinsic value is so low. And this was, once again, the same for Coca-Cola. The Coca-Cola intrinsic value was also really low relative to the trading value, but they had also stronger earnings similar to Pepsi. They both trade at similar price to earnings, and so with a price to earnings of about 30, this is actually suggesting that these companies trade at a bit higher price to earnings than other stocks would be at this time. We consider that the book value is still really low, and with the book value being lower, this means that the intrinsic value is based off of the earnings primarily. So if the earnings fluctuate even a little bit, this will likely move the intrinsic value rather dramatically, which may not help the volatility of this company in the future. So I think that this company could be quite volatile in the future, despite the fact that the earnings aren't fluctuating very much, just because even if the earnings fluctuate a little bit, the book value has so little support to the intrinsic value that the company may trade at a different price just based off of the earnings dropping even a little bit. Now, just to talk further about the assets, we consider that they've been increasing their debt year over year, and we consider that the shareholder equity has been increasing as well. We consider that it's a little bit flat in recent years, but in the past they have decreased in shareholder equity, and so they were at about $23 billion in shareholder equity, and now they're at about $14 billion. So according to the shareholder equity chart, this shows that the company is worth now less than what it was back in maybe 2015, and so therefore we would have to decide that this company seems to be losing money, but of course that isn't the case. So I'm not sure exactly why. I'd be happy to see what you guys think in the comments down below, just to figure out exactly what is going on with the shareholder equity at this time, or in the past to how it's been dropping back in 2015. This was the same with Coca-Cola actually, so it's pretty fascinating to see this, because the companies did make plenty of money during that period of time, of course, and they've been making plenty of money for many years. We consider that the company was making plenty of money back in 2015, 2016, etc. This company currently makes about $1.7 billion each quarter, and so that is generally a pretty good number for this company. And this company seems to be increasing that net income year over year at least a little bit. We consider that the yearly net income has grown a little bit, ever so slightly, really. But that helps to increase the earnings, that helps to increase the shareholder equity, because the company should be making more money that will become part of the company's assets, as is cash, or maybe investments, other things like that. That will go into the shareholder equity. That increases the book value. That should help to increase the intrinsic value, which also helps to increase the trading value. So it basically is allowing the company to do better. And of course, we would hope that the company's earnings do increase, of course. This company will be able to pay out a higher dividend with the higher earnings, of course. This company will be able to pay out a higher dividend with the higher earnings, and this company seems to be able to at least grow its earnings, at least slowly. Unfortunately, this company is not a fast-growing stock, and because the company already has its customer base kind of out there, people already know what Pepsi does. So the problem is their customers already know whether or not they like Pepsi things or Pepsi items, so maybe even their subsidiaries, people know whether they like Lay's chips or whether or not they like Fritos or Cheetos or things like that. So their customer base isn't really going to change very much. So we have to understand that this company is likely not going to increase earnings very quickly, but they're likely not going to lose earnings very fast either. So this company is really steady, and therefore this company is likely to be a very safe dividend stock, especially through recessions and other economic downturns. So this company will still be very profitable likely during those times, and that gives Pepsi a bit of an edge over other companies that may struggle during a pandemic or a recession. Now, consider that the company's trading value has increased year over year relatively steadily, and this has allowed the company to have a higher price to earnings, which is kind of unfortunate for a value investor. So for me, as a long-term value investor that's also looking for good dividend income, I find that this company is quite a bit overvalued for me at this point, just because the price to earnings not only is just too high, but also the intrinsic value is not giving me much to work with either. Because the company has so few assets, this is not very helpful to the company's trading value, and this doesn't help to support the current trading value of the stock. So therefore, we can see that the earnings have been increasing year over year, but we can also see that the price is also increasing at a faster rate than the earnings. This allows the price to earnings to increase too quickly. This is why the price to earnings is so high. Once again, this is the same with Coca-Cola, so this seems to be following that general industry market, but we have to understand that this is still not really justified, and I would expect the company's price to earnings to get down to between 15 and 20. So for me, I plan to wait before I enter a position or consider entering a position in this company. Now, I really want to get into what is so good about this company, as they also do really give back to their shareholders because they have consistent profitability. So what they can do is they can buy back their own stock consistently. We consider that the outstanding shares in the market have decreased year over year. This allows the company's book value to be higher, and this also helps to increase the intrinsic value because there's less outstanding shares in the market. There's more assets that will be distributed across less shares. And so this is helpful to the shareholders. So I think that that's very important, and it's very important that a company is buying back their own stock, giving out a dividend, doing things like that. We consider that Pepsi is also offering a pretty strong dividend. This is very similar to Coca-Cola at about 3%. And so overall, this company has been willing to increase their dividend year over year, and this gives them currently a dividend yield of about $1.07 per quarter per share that you own. So this is fine for this company, with them offering a pretty steady dividend. Even at this trading value, that's pretty strong, and that allows the company to at least give out good dividend growth for their shareholders. So of course, this is not a very fast growing company. We have to understand that this company is still very profitable though, and can pay out a very strong dividend, especially during economic downturns. So overall, I do think that the company at this point is overvalued, and I expect the company to come down in trading value before that. But I do think that this company will be a strong long-term investment for its shareholders. So I think that if you're holding this company, or you're interested in buying a stake in this company, if you're willing to hold it for maybe 50 plus years, this may allow Pepsi to give you a pretty strong return. But for right now, I'm not sure if I'd invest in this company at this point, so it's hard to say exactly what the company is going to do right now, especially since the company has a higher price earnings than I would like it to be.